Hello. Welcome to our next chapter, that is your input tax credit. Now, this will be a comparatively bigger videos compared to others because this is spreading to approximately 4 pages and it is a very important chapter. So, let's start with ITC. So, first and foremost is what is the eligibility for taking ITC? That is, who is eligible to take ITC and on what inputs. So, first is you will have to take registration under GST. Only those people who are registered under GST will be allowed to take ITC. And second is the goods and services on which you are taking ITC. Now, what is your ITC? You purchase some good, you purchase some service. Now, on this good that you have purchased, if you have paid tax, if you paid GST, and you are not the final customer, you are not the final consumer of this good or service. In such a case, since you are buying this good or service to further sell it to someone, therefore you will get ITC of this GST that you paid. That is, you will get credit of this input tax. Therefore, it says input tax because what all input is required for you to make your goods and services, on that input, whatever tax you have paid, government gives you a credit. Therefore, the word is says input tax credit. So that is, you have to take registration under GST, and the goods and services that you are buying, that you are purchasing, they should be used for business purpose. That is, they should be used for business purpose. That is, whatever business you are doing, it should be used for that purpose only, then will you get ITC. And an important point is there is no need to reverse ITC on molds and dies provided by your OEM. OEM is your original equipment manufacturer, to component manufacturer free of cost, since it is in the course of business. So even though this is being given free of cost, but however, since this is due to business, since it is in course of business, therefore you do not have to reverse any ITC. Okay, so this is your point with regards to mold and dies. Now, other conditions for taking ITC. So we will do this conditions for taking ITC. That is, first is your possession of tax paying document. That is, you should have an invoice, you should have some supporting against which you have taken ITC. There will be no ITC when tax has been paid towards demand by department involving fraud or willful misstatement. That is, if the department has demanded some amount from you in case of tax, and then you pay them, then you will not get ITC of that amount because they had to demand it. You did not pay it on your own. Now, next is only invoices furnished by supplier in his GSTR1. So the supplier will furnish GSTR1, that is his outward supplies. So only invoices furnished by supplier in GSTR1 can be availed. No ITC if supplier has not furnished invoices in their GSTR1. So since you are buying from the supplier, only and only when the supplier shows that, boss, this is my outward supply, only then will you be given this ITC because this is your inward supply. The next is goods shall have been received. That is, the goods that on which you are claiming ITC, you should have received those. And where goods are received in lots, that is, when you do not receive all the goods at once, you receive the goods in parts. So when goods are received in lots, ITC will be available when you receive the last lot. So for example, it is a lot of, say example, 100 units, and in each shipment I am receiving 20 units. So now only after five, when I receive all the five lots, all the 100, on the last lot, when I receive the last lot, will I get my ITC. Next is supplier should have actually paid tax to the government. That is, the supplier from the person whom you are buying, he should have actually paid tax to the government. Only then will you get ITC. Next is you have to file GSTR 3B to avail ITC on inward supplies. You have to file your GSTR 3B, only then you will get your ITC on inward supplies. Next is no ITC can be claimed by recipient even if it is shown in GSTR 2B. Okay, so no ITC can be claimed even if shown in GSTR 2B. That is inward supply from supplier having new registration. If the supplier has defaulted in payment of tax and your default continues, that is, the supplier, he has not paid tax and he has and the default is still continuing, that he has not rectified the default. If the tax paid in GSTR 3B is lower than the tax paid shown in is lower than tax shown in GSTR 1, that is your outward supply. Next is supplier has taken more ITC in GSTR 2B than GSTR 3B. Supplier has paid higher proportion of taxes from electronic credit ledger than what is allowed. If he is not allowed that portion, of course he will not be allowed to claim ITC. Okay. Then next is payments to be made in 180 days from issue of invoice. So for example, you purchased something from your supplier, and only if you pay back your supplier, if you pay your supplier within 180 days, will you be allowed to take ITC. So payments to be made in 180 days from issue of invoice, else credit will be added to output liability and interest at the rate 18% will be added, because you will be allowed ITC at that moment itself, correct? But after 180 days, if you still not made the payment, this will be added back where it will be added to your output tax liability, and they will also charge interest at the rate 18%. However, this credit will be allowed once you make the payment. That is, once you paid the supplier, this credit will be allowed to you. Next is no ITC if depreciation has been claimed on tax component under your IT Act. IT Act is your Income Tax Act. So if you claim depreciation under income tax, so you will not be allowed credit under GST. You will be allowed benefit only at one of the places. If you've taken credit under GST, you will not be allowed depreciation in income tax on the tax portion. Now, what is the time limit to avail ITC? Time limit to avail ITC. So this is the amendment over here. Earlier the dates were different. So now it is 30th November of your next financial year, or your date of filing annual return, whichever is early. That is 30th November or date of filing return, whichever is earlier. 30th November, date of filing return, whichever is earlier. Okay. No ITC on goods and services which is used for non-business purpose, or which is used to make exempt supplies. That is, you will not get ITC, you will not get input tax credit if you are using it for non-business purpose. If it is good and services that you have purchased, you are not using it for business purpose, or you are using it to produce any exempt supplies. In that case, you will not get ITC. ITC is available on goods and services used for business purpose, because non-business purpose is not allowed, and it is also available for taxable and zero rated supplies. Now, what is your zero rated supplies? Remember, zero rated supplies only has two supplies, that is your SEZ and your export. Okay, so these supplies to SEZ, and only if you are exporting, only these two are included in your zero rated supplies. So remember, for zero rated supplies, even though no tax is charged, ITC, you will still be getting ITC, but for exempt supplies, no ITC will be available. Okay, so I've written over here also, zero rated supplies is export and supplies to SEZ unit or developer. And your last part is no ITC if place of supplier is your place of supply, but it is different than the place of recipient. So this is your hotel service. If you, when you solve the question, you will understand that in such a case, your place of supplier and your place of supply is the same, but place of recipient is not the same. So for example, someone from Delhi comes to Bombay and stays in a hotel. Now in such a case, your place of supplier and place of supply is Bombay, but your place of recipient is in a different state. So therefore, in this case, you will not be receiving ITC. Okay. Now, next part that a lot of students get confused is your apportionment of credit. That is, when you buy goods which are being used for all of the purposes, in such a case, how do you distribute credit? So a portion of credit for inputs. So this is your inputs that you use. There is a separate table for machinery, etc. So this is apportionment of credit for inputs. So if you use inputs, so first total ITC available, that is whatever ITC that you have received, full everything, this is your T. Now you will subtract anything that is exclusively not used for business. Any ITC that you have received which is exclusively not used for business, to use for personal purpose, not business, which means that it is used for personal purpose. So of course you will have to subtract personal purpose, because we will not give you credit for that portion. So we subtracted T1. Then what are we subtracting next? Exclusively exempt supplies. As we already studied, there will be no ITC on exempt supplies. Therefore, we are straight away removing any tax that you have paid on inputs which are used to make exempt supplies. Okay, so you are reversing, you are removing that ITC on the inputs that you are buying to produce exempt supplies. Okay, exclusively exempt supplies. So therefore, this is your T2, and this also we have subtracted. Then next is your block credit. So under GST, there have been certain things marked as block credit. These will not be considered, and no ITC will be given on these, even if it is used for business purpose. So that is your block credit. We will be studying that later. So that is your T3. Now from T, when you subtract T1, T2, T3, what you get is T1. That is, this amount of ITC will be credited to your cash ledger, that is your C1. Okay, this is what will be credited to your cash ledger. Now you have to subtract, that is exclusively taxable and zero rated. Exclusively taxable and zero rated. Now you have to understand that both this we are subtracting. Why are we subtracting? Because this is pure ITC. This T4, that is, this you will receive proper ITC. That's why we are subtracting. This is 100%. This you will receive proper. Nobody is taking this away from you. Only for the purpose of calculation we are subtracting this. Therefore we have subtracted this. So now what are we left? We already removed exclusively non-business and exclusively where you are not getting. Then we remove exclusively where we are getting ITC. Okay, so that is your T4. Now what you will be left with is inputs which either also used for exempt supplies, also used for taxable, or also rated for, also used for business purpose, also used for non-business purpose. So now you have your khichdi over here. So therefore we have first subtracted. So please understand, therefore this is not a difficult table. Please don't be scared of it. If you want, I will explain it to you once again. So first we subtracted all these three ITCs not available at all, therefore we subtracted. Then this we subtracted because on this is pure ITC, that is full ITC you will be receiving. Now C2 that you have, this is credit to be a portion, that is this is your khichdi. So over here, what do? You do subtract value of exempt supplies. Now how do you do this? This you do C2 into E upon F. This is C2 that we have calculated over here. E is your exempt turnover and F is your total turnover. So you find a ratio that, for example, if I made sales of 100 and out of 100, my 40 rupees sales was export. Now what does this mean? This means that 40% of my turnover is exports, and therefore, or 40%, sorry, not exports, so exempt supply. That is 40% of my turnover is exempt supply. So I should not be receiving credit on 40% of my inputs. So therefore we are finding a ratio over here, that is C2 into your ratio of exempt supplies, exempt turnover upon your total turnover. So by this you get D1. This is you have subtracted. And next is your value of non-business supply. So they have already assumed that it is 5% of 5% of T2 you will 5% of C2 you will be using for non-business purpose, that is your personal purpose. So this also D2 we have subtracted, and your C2, your C3 is your eligible credit. Okay, so now your eligible credit is your C3 and also your T4 that we have subtracted over here. So this is the entire credit that you will be getting, and I hope this table is clear to you. Great. So now next part is your examples. I put an example. It is from the ICI module itself, so that so easy footwear manufacturer of two varieties of Hawaii slippers. One is exempt and five varieties of other sandals and shoes. Okay, so your two varieties of Hawaii slipper. Your Hawaii slipper itself is exempt, and five varieties of sandals and shoes, those are taxable. So you understand now. I will have some common inputs which I will be using in my slipper also and my sandal and shoes also. So therefore, since my slipper is exempt, I will have to do the bifurcation. Dyes are used in the manufacture of all footwear. Bright pink is only used for one of the Hawaii varieties, and black is only used for sandals and shoes. So since this pink is only used for Hawaii variety, of course it is used for exempt. So this you can, as it is, remove. Black is used only for sandals and shoes. This also you can remove because this is your pure credit. Okay, so this credit you will be receiving for black. For pink you will not be receiving any credit. Great. Blue and yellow are used for all varieties. Now this is your mixed credit. You will have to find proportion for this. Brown is used for non-business purpose. Since brown is used for non-business purpose, we can conclude that brown also you will not be receiving because it is a purely not allowed ITC. Okay, so inward supplies in the month, they have given ITC, that is what ITC you have paid on each of the color. And I hope this question will be solved. You will be able to solve now. If you want, you can pause the video here. I put the solution also. You can pause the video, solve it on your own, and then we'll move forward. Okay, so pause the video, solve the question, and then move forward. Great. Okay. Now next is your apportionment of credit for capital goods. So what table that we did C1, then we subtracted, we reached C2, then C3, everything that we did, that was only for inputs. Now we are doing apportionment of credit for capital goods. That is, for example, any machinery or something you purchase. Now this machinery manufactures both your taxable supplies and exempt supplies. Now how to bifurcate? Therefore, we have to do for capital goods also. Now another point to remember for capital goods is, for capital goods we assume that their life is 5 years. Now 5 years means there is each year as 12 months, so 5 into 12, that is your 60 months. So we assume that each machinery has a useful life of 60 months. Therefore you will see that over here we have divided it by 60. So let's see what the formula is. That is ITC on capital goods for common use. So that is your A, that is only your common, only capital goods which are being used to produce both, that is your A. Now you will add ITC on capital goods earlier used for non-business or exempt, and now for common use. For common use means they are also producing exempt supplies and they are also producing taxable supplies. Okay, so ITC on capital goods earlier used for non-business or exempt. That is, since they were earlier only used for non-business purpose or they were only used for exempt purpose, tell me, was this ITC allowed at that time? No, right? Since it was used only for non-business purpose, we never allowed this ITC. Therefore, now since it is being used for common use, we will be adding this ITC that we had paid earlier, but we were not allowed ITC because it was only used for non-business or exempt supply. Acha sir, will we be adding the entire ITC? No, you will not be adding the entire ITC. You will reduce 5% per quarter and then you will add. That is, why will you reduce? For example, you had paid 100 rupees ITC and you used it for 2 quarters for non-business or exempt, or for you used it for non-business or exempt purpose, correct? So now this out of 100, since you used it for 2 quarters, I will reduce 5% per quarter, which means 10%. So this means that boss, 10 rupees you have already used out of this machinery stacks to manufacture your non-business or exempt supplies, and the rest 90 now you are using for common supplies. Therefore, you will add only 90 over here. Clear? I hope that is clear to you. Then next is ITC on capital goods earlier used for taxable or business and now used for common purpose. So therefore, since they are now being used for common purpose, this will also have to be added in the HDD. Okay, now this is your eligible common credit. Then you have to add common credit to be added to ITC in GST or 3B each month. So this is your common credit that will be added, and the sum will have to be reversed. So common credit is TM is equal to TC divided by 60. This is 60 because there are 60 months. So therefore you will calculate for each month. This GST 3B is filed each month. Therefore we are dividing it by 60 and we are adding it to the ITC. This ITC we are eligible for. And what you will be subtracting? ITC for exempt turnover to be reversed in GSTR 3B each month. This is again the same, exempt turnover upon total turnover into your TM. Okay, got it? So first you added, then you subtracted your ITC which is being used for exempted turnover. Clear? So I hope this is clear. First we did what is our mixed rate, this is our khichdi, then we divided by 60, that how much am I eligible per month, and then you subtracted whatever is my exempt turnover ratio. Clear? Now another thing is, banking company and financial institutions which include NBFC which accept deposits, they have an alternative to avail 50% of eligible ITC on inputs and capital goods each month, and remaining ITC shall lapse. Option 1 exercise cannot be changed in the financial year. So to come out of all of this, calculation, etc., they have been given a shortcut that was only 50% of whatever tax you paid will be allowed as ITC, rest everything will lapse. So you don't have to do all of this calculation, etc. So this is an option given to them. Now coming to our next part, that is your block credit. So you remember we did a block credit while we were doing a table of inputs. So no input tax credit on below goods and services because this is block as per your GST. So block credit is first any motor vehicle, vessel or aircraft which is used for passenger transportation. That is motor vehicle, vessel or aircraft used for passenger transportation. Remember over here it says passenger transportation. That means for goods it is allowed, but for passenger transportation it is not allowed. Okay. Ineligible motor vehicles. So which are these motor vehicles which are ineligible? If they have a seating capacity. Okay, so we are studying this part, this motor vehicle. If they have a seating capacity of less than or equal to 30. Now this 13 seats includes the driver's seat also, which means 12 passenger seats. If your motor vehicle has less than 12 passenger seats, then it becomes a ineligible. You will not be getting any credit for this. Now motor vehicle exclude, over here you have to remember, there is no credit on motor vehicle. There is no credit on motor vehicles. So when we say motor vehicle excludes, this means that there will be credit on these items, correct? Got it? Because motor vehicle is already in the negative list. And if we are excluding something from motor vehicle, that means those items ITC will be available. So vehicles running on fixed rails, this can be your trains. The next is your special purpose vehicle used in factory. And third is vehicles with less than 4 wheels and engine capacity up to 25 cc. So you have to remember it is a and. Therefore, your vehicle less than 4 wheels, that is an auto, will not be covered here because their engine capacity is more than 25 cc. So vehicles with less than 4 wheels and engine capacity up to 25 cc, these three are excluded from the definition of motor vehicle. Okay, now in some cases credit will be allowed. Credit will be allowed if this motor vehicle, vessel or aircraft that you have purchased, your whole business is only purchasing and selling. That is, you have purchased it only to sell it forward. So if they are further sold, then you will be allowed ITC because you are a trader of this. Next is if they are used for taxable transportation of passenger. Over here, you remember we said it is used for passenger transportation. However, if it is taxable passenger transportation, then credit on the motor vehicle or on the whichever vehicle it is, that also will be allowed. If you are imparting training on such vehicle, if you are teaching how to drive this vehicle, then it is the credit will be allowed if you are imparting training. Next is your lease or rent to employee. That is, if it is a statutory obligation that you have to lease it to your employee or you have to give it to your employee, only in such a case credit will be allowed. That is if the law says it. Next is your transportation of goods. That is if over here, I remember I told you that for passenger transportation it is not allowed. So what you have to remember is taxable passenger transportation is allowed, and in case of goods is also allowed. Next is provided by employer to employee under any statutory obligation. If the statute says, if the law says, then it is okay. Clear? So this part is clear, I hope, for plot credit. Now coming to your next part, that is food and beverages, outdoor catering. So food and beverages, your outdoor catering, any health services, cosmetic and plastic surgery, membership of clubs, fitness center, and this is your life and health insurance. So I've added images so that it is easier for you to remember by image memory that yeah, I had seen these. So that is your any food, beverages, any catering services, health services, your cosmetic surgery, then this is your gym membership, etc. And this is your life and health insurance. So all of these, any GST component you have to pay, ITC will not be allowed. When will it be allowed? If this is further subcontracted or if it is provided by employer to employee under statutory obligation. Next part is your inward supply is received by taxable person from a composition supplier. Any inward supply, if you remember, we have already done this composition supplier. So since a composition supplier cannot tax charge, cannot charge tax, however, it is still blocked. So inward supply is received by taxable person. If you purchased anything from a composition supplier and if by chance also he put GST on the bill and you paid it, ITC will not be allowed, when actually the rule is he will not be allowed to charge ITC itself. Okay. Now, if you remember, I had put a star mark over here on the motor vehicle, vessel, and aircraft. So, any ITC on insurance, servicing, repair, and maintenance will be allowed only if the eligible vehicle is used for eligible purpose. That is, the vehicle ITC is not allowed. That we already studied. But any expense that you do on the vehicle in the form of any insurance, any repair, etc., etc., that ITC will also only be allowed only and only if ITC has been allowed on the vehicle itself. Only then ITC on further expenses on that vehicle will be allowed, otherwise it will not be allowed. Now coming to your next thing that are blocked in credit, that is work contract services for construction of immovable property for self. Any immovable property that you made for your own thing, it will not be allowed. For example, uh, now, what does this mean? So, what credits will be allowed? That is any routine service like repairing, maintenance, renovation. That is when your expense is not capitalized, when it is charged to P&L, then ITC will be allowed. Next is if it is further subcontracted, and third is if your immovable property is your plant and machinery. Only and only if your immovable property is your plant and machinery that you have constructed will you be allowed ITC. If you made a, for example, if you made an office building, no ITC will be allowed because that is for your own self. Next is your inputs used by NRTP or any import or services by NRTP. NRTP is a non-resident taxable person. So any inputs which are used by him or any import or services that he has done, it will not be allowed. It will only be allowed if it is import of goods, because over here you have to remember it is import of services. Import of goods will be allowed. Any inward supply is used for personal consumption. Of course, no ITC will be allowed on this because this is for personal purpose. It is not for business purpose. Therefore, it is being blocked. Any free samples, gifts, or any goods that were lost or stolen, destroyed goods, on that also you will not be getting any ITC. Destroying time expired drug and medicine will lead to ITC reversal by the manufacturer. That is, if any medicine that you have manufactured and they have been expired, so now you will have to destroy these medicines. So, and all the inputs, all the ITC that you paid on the inputs to make that medicine, that also has to be reversed. Okay, so free sample, gift, lost goods, any stolen or destroyed goods, on all of those ITC will not be allowed because you did not further supply it to the customer. Okay, now credit will be allowed if input used for buy one get one free offer. So you might say that, boss, when I, for example, I have two goods, good one and good two, and there is a combo offer that when I buy one, I will get two free. Okay, when I buy good number one, I will get this one free. So does this mean that I will have to reverse ITC because sir, you said that free samples is not allowed. But since it is a buy one get one offer, it is considered as a composite supply. Therefore, it you will be allowed ITC on this. ITC does not have to be reversed. And last is any tax paid in fraud cases, detention, confiscation, etc. In such a case also ITC will not be given to you. Clear? Okay. Now this was a block credit. Now coming to your uh, part of apportionment of credit in case of capital goods. So claiming ITC on change of status, that for example, if a person was liable to register for the first time or voluntary registration. So when you take registration for the first time, earlier you were not registered under GST, but now you are. So you are taking registration for the first time, or you're taking any voluntary registration. That is, even though you have not reached the limits, you still want to voluntarily register. In such a case, which goods, because I have already purchased some goods, I have already purchased some input good, I've already purchased some capital goods, on which goods will I get my ITC? Because I am now being registered, but my goods have already been purchased earlier. So you will get ITC. So in this case, your inputs held in stock, that is on inputs you will get, but on capital goods you will not get ITC. You will get ITC from now on. Any capital goods that you purchase from now on, you will be getting ITC, but any capital goods that you had already purchased, you will not be allowed ITC. Next is switch from a composition to regular. Now under composition, there was no concept of ITC. But when you're shifting from composition to regular, now you'll be getting ITC, correct? So therefore, you will get ITC on both your input and your capital goods. You will get ITC on both of them. So therefore, your green is your yes and red is your no, so that it is easier to understand. So now when you close your eyes and you remember the table, you will remember that there is only one red, everything else is green. That is, ITC will be allowed everywhere except when a person is registering for the first time or voluntary registration. In case of capital goods, that will be no. And next is any exempt supplies now becoming taxable supplies. Any supplies which are earlier exempt, so you were not allowed ITC on the stock and capital goods, right? Because earlier it was an exempt supply, so you were not allowed ITC. But now since it has turned from exempt to taxable, so you will be given credit. So therefore both of these will be yes. Okay. Now if your ITC claim, if your claim of ITC is more than 2 lakh, it needs to be certified by a chartered accountant or a cost accountant. This claim that you're doing, if it is more than 2 lakh, it has to be certified. ITC can be availed within 1 year from date of issue of tax invoice. That is, if you want to claim ITC, this ITC should have been from an invoice which was raised within the last 1 year. Okay. And next is your ITC will be reduced by 5% per quarter or part thereof for capital goods from the date of invoice, that is period it is used. Since earlier, for example, since earlier when you switch from composition to regular, under composition you were not eligible to take ITC, correct? So therefore we will be subtracting the time period for which you use it as a composition supplier. We will remove that portion of ITC and only then we will be adding the remaining ITC of the machinery. Okay, so that is your 5% per quarter. Clear? So 5% per quarter means quarter has 3 months. Correct? Quarter does not have 4 months. Quarter has 3 months. So in a year you have 4 quarters. That means in a year there will be 20%. Correct? 20%, 5% per quarter means 20% per year. Now you multiply by this by 5, that is 100% for 5 years. This is what I was telling you, that a machinery has life of 5 years. Therefore, machinery has life of 5 years means 20% each year, which means 5% per quarter. Okay, so this was your claiming ITC on change of status. Now what we are doing reversing ITC on change of status. So goods were ITC to be reversed. So when a normal scheme switches to a composition levy, now until now you were under normal scheme. So we gave you the entire ITC, correct, since you were under the normal scheme. But now since you are switching from your normal scheme to your composition scheme, you will have to reverse the ITC that we had originally given you. Or when supplies get wholly exempt from tax, for example, they were earlier the inputs that you were using to make the outward supply, that outward supply was earlier taxable, but now due to some government notification or etc, that taxable supply has now become exempt. So in such a case, of course, you will have to reverse the ITC, because no ITC is eligible on exempt supplies. So you will have to eligible on stock and capital goods, both of them are yes. ITC will be reversed based on useful life left in months on pro rata basis. So I have told you again and again, life is equal to 60 months. So you have to check that, boss, how much of my life is remaining. On that basis, you will be calculating. You have to ignore any part of the month. Okay. So for example, your capital good had been used for 4 years, 6 months and 15 days. Correct? So now your useful life remaining is 5 months. You have to ignore the 15 days. Useful life remaining is only 5 months. This 6 months, 15 days is basically rounded off to 7 months. Why they are saying ignore part of month? Because this is actually 5 months plus 15 days. So they are asking you to ignore this. So they are saying that, boss, only useful life of 5 months is left. So reversal that we will be doing is of 5 by 60. That is, out of 60 months, only for 5 months you will be using it for purpose when ITC is not allowed. Therefore, we are reversing that. So therefore, it is your 5 divided by 60. Any balance lying in electronic ledger lapses, because of course you have any electronic credit, you will not be getting any credit. Therefore, that balance will lapse. Reversal amount to be added to output tax liability of the person. This amount that we have reversed, this 5 by 60, this will be added to the output tax of the person. And coming to your last part of the chapter, that is amount payable. Amount payable when capital goods on which ITC has been taken is sold. For example, you took some goods, you purchased some goods, you paid GST on it and you claimed ITC. Now what happens when you sold this good? Okay, so when this capital good has been sold, what happens in such a case? So amount payable, that is the tax that will be charged to you now, will be higher of ITC taken on such goods reduced by 5% per quarter or part thereof from the date of issue of invoice. That is, we are subtracting that portion of the time for which you have already used this good. Therefore, we are reducing it by 5% per quarter, or tax on the transaction value. That is, for example, if you purchase this machinery originally for 1 lakh and you paid tax at the rate 18%, so you paid 18,000 of GST. Okay, and you used it for say, for example, you used it for 2 quarters. So since 2 quarters, 5% per quarter means I will subtract 10%. Okay, so out of this 18,000, I will be subtracting 10%. That is 90% is remaining. So how much will that be? 90 and 62, so 1520. So you will be left with 15,200 worth of credit. So we will be doing higher of 15,200. 90% is correct, na? 9 and 8 are 72. Correct. This will be, sorry, 16,200. I'm doing mental math, so don't go on the number. So 10% I have subtracted that. That means I have subtracted 1,800. So I am left with 16,200. So your first part will be 16,200. And for example, I sold this machinery. I sold this machinery for 3 lakh. Now GST component of 3 lakh at the rate 18% will be what? 54,000. Now 54,000 or 16,200, whichever is higher, that will be my output tax liability in case of this transaction. Clear? I hope you got it. Great. In case of partial transfer of business or demerger, ITC to be apportioned in the ratio of value of assets between new and old entity. This will be done state wise. For example, we had a company which was AB Limited. Now this AB Limited has been bifurcated into A Limited and B Limited, and AB Limited had, say for example, ITC of rupees 100. Okay, so now this 100 will be distributed between A and B based on the amount of assets that each of them have. On that basis, your ITC will be distributed to both of them, and this calculation will be done state wise. Coming to your second last part, that is distribution of credit by ISD. Is it readable? Yeah. So distribution of credit by ISD. Your ISD is your input service distributor. Okay. So your ISD is an office of business which receives tax invoice for input services and distributes available ITC to other branch offices of same business by issuing ISD invoice. So what happens? For example, company has a lot of different offices in different states. So what happened, instead of raising invoice for each of the different business, each of the, in different state, what will be doing? You will issue one invoice to the ISD. If this same service is being used by multiple companies of different states of the same business, you will be issuing one invoice to the ISD, and the ISD will now distribute the ITC to each one of them. So ISD will also require a compulsory separate registration that has to be registered separately. ITC on input services is distributed only to those who have used the same in course of business. Only and only the states, only and only the units which have used these services, it will only be bifurcated to, it will only be distributed to them. If input service is attributable to more than one recipient, in such a case, ITC distributed in ratio of turnover in the state. Okay, and it will be turnover of previous financial year. So that will be the ratio. So over here, if you see, the ratio was value of assets. Over here, you see it is the ratio of turnover in the state. Next is ITC attributable to recipient is distributed even if recipient is unregistered or make exempt supply. Even still, ITC will be attributable. Of course, he will not be allowed to claim it since he is either unregistered or exempt supply, but it will still be distributed to them. Okay, so I hope this is clear. He will not be able to claim this ITC, but it will still be distributed to him. So basically, that ITC will be wasted. Okay, so this is an example. ABC Limited, a manufacturer, has paid bills of an advertising company amounting 24 lakhs for two varieties of cakes which are manufactured at locations Pune and Bangalore. Now, if you notice, these are in different states. The company had a total turnover of 112 crores. The turnover of Pune was 5 crores and turnover of Bangalore was 10 crores. So that means Bangalore's turnover is double of Pune. So hence this 24 lakhs will be split in the ratio of 5:10. That is nothing but a ratio of 1:2 between Pune and Bangalore. So 1:2 means the ratio will become 8 and 16 lakhs. So Pune will get ITC of 8 lakhs and Bangalore will get ITC of 16 lakhs. Now your credit of IGST, that is the ISD, the input service distributor, when he gets credit of IGST, that will be distributed as credit of IGST itself to, for example, in this case, it will be distributed to Pune and Bangalore as IGST only. But if they have any credit of CGST, SGST or UTGST, that means anything other than IGST, and if the recipient and ISD are located in the same state, that is the ISD's registration and the recipient, if both of them are located in the same state, then input tax credited under the same category of tax. That means if they have credit of CGST, my recipient will also get CGST. If they have credit of SGST, my recipient will also get credit of SGST. However, if the recipient and your IST are located in different state, if they are located both in different state, in this case, even since the credit is of CGST, SGST, whatever it is, input tax that the recipient will get, that will be treated as IGST, because it is an interstate. This will be treated as an interstate, and this will be as IGST credit. Clear? I hope this is clear with you. Coming to our last part of the chapter, last part, that is your how to utilize ITC. So this uh, that is the order of utilization of ITC. So I made this table. So if you have IGST liability, so I put these numbers, I'll help you explain. If you have IGST liability first has to be set off against credit of IGST itself. Okay, any IGST liability will first be set off against your IGST credit. Now next is, if you still have any remaining credit left with you, if you have any IGST credit, if you still have any IGST credit left after settling your IGST liability, then you will settle liability for CGST and SGST. There is no separate order. You can do any amount for any of them. It does not have to be equal. They are just at the same. You can do either of them. You can do either CGST, you can do SGST, you can do both equal, you can do anything. Okay, so first my credit of IGST. Okay, first my credit of IGST have to be utilized against my liability of ITC. Now once my liability of ITC has been completed, if I still have IGST credit, I can use it to settle off my CGST and SGST liability. For example, if I don't have, now your CGST credit, my CGST credit will first be used against CGST only. What you have to remember is CGST credit cannot be used against SGST, and SGST credit cannot be used against CGST. They cannot be interlinked. Okay, so CGST has to be used only against CGST first, and if there is still credit left, then you will be utilizing it for IGST. And same with SGST. SGST first it will be utilized for SGST. If there is still credit left, you will be utilizing it for IGST, but in no circumstance can you use SGST credit for CGST or CGST credit for SGST liability. I hope this table is clear to you. Let me know in the comment section if you still have any doubts. Okay, and this is the new rule, that is your rule 86B. This was added, I think, last attempt, that is your rule 86B. So what does it say? It is applicable only if your taxable supply, only and only if your taxable supply, it does not include exempt and zero rated. Okay, only if your taxable supply is more than 50 lakhs in a month. If it is more than 50 lakhs in a month, rule 86B will be applicable. So while doing questions, if you see someone's turnover per month greater than 50 lakhs, you have to remember that both rule 86B will be applicable to them. Minimum 1% of output tax liability shall be discharged using cash ledger. This means that maximum only 99% of the total output tax liability will you be allowed to use via your credit ledger. At least 1% you will have to pay via cash ledger. This means that even if you have sufficient credit in your credit ledger, for example, your liability was for 100 rupees, and you have, this is your liability, okay, and you have a credit of, say, for example, 150 rupees. So till when 86B was not applicable, we would automatically set off this against, and we would be left with a credit of 50. This was what originally used to happen. But now only maximum 99% of your liability you can pay. That means out of 100, only 99 rupees you can use from your credit. So you will be left with 51 rupees of credit, and at least 1 rupee you will have to pay via your cash ledger. Clear? 86B will not be applicable when income tax paid is greater than 1 lakh in each of the last 2 financial years. Then 86B will not be applicable. And next, if any person has received refund greater than 1 lakh in preceding financial year on account of unutilized, if you receive refund of more than 1 lakh on account of unutilized ITC under zero rated supplies. I hope you remember what zero rated supplies is. Zero rated supplies is your exempt, is your export and your SEZ. Zero rated supplies without tax or your inverted duty structure. That is, if that is more than 1 lakh, then 86B will not be applicable. So 86B becomes applicable only if your turnover is more than 50 lakhs in a month, and it will not be applicable under these two circumstances. And we are done with our chapter of ITC. And I will see you in the next video, that is of registration. Like the video and we'll move forward.